In this lesson, we'll be discussing health savings accounts. After completing this lesson, you will be able to recognize tax-favored arrangements, determine eligibility to contribute, calculate the limits on contributions, determine what qualifies for an adjustment, understand how to report distributions, explain the effects of distributions not used for qualified medical expenses, and identify information documents used in reporting. Health savings accounts are tax-favored medical savings accounts that enable taxpayers to pay for current medical expenses and to save for future qualified medical expenses on a tax-free basis. The accounts are owned by individuals, but they allow contributions from employers and others. Now, there are several other types of tax-favored arrangements, and these provide tax advantages to offset healthcare costs. They include Archer Medical Savings Accounts, Medicare Advantage MSAs, health reimbursement arrangements, and flexible spending arrangements, all of which are out of scope for VITA, but we want you to be aware of them so that you can recognize them. Now, there are plenty of health savings account benefits. The amounts contributed to the account by the taxpayer and others, but not including an employer, can be used as an adjustment to income, so it will end up reducing taxable income. Amounts contributed to the account by an employer can be excluded from gross income, so those benefits from the employer will not be included in the taxpayer's take-home pay. Interest and earnings on the account are tax-free, and distributions are tax-free if used towards unreimbursed qualified medical expenses. The accounts are also portable with no distribution deadline. So unlike some retirement accounts that require a minimum distribution once the taxpayer reaches a certain age, health savings accounts can continue to accrue interest and earnings with no obligation to take a distribution. In terms of enrollment, taxpayers must enroll in what is called a high deductible health plan, or an HDHP. And after that, they open a tax-exempt account to pay for qualified medical expenses. So what exactly is a high deductible health plan? It's a health plan that has a higher annual deductible than typical health plans. So for example, for a family plan, a deductible of $2,600 or greater was considered a high deductible health plan in 2016. Now, an HDHP also imposes a max limit on the sum of annual deductible and out-of-pocket medical expenses that the taxpayer must pay for covered expenses. So, for example, the family max in 2016 was $13,100. For someone to be eligible to open an HSA account, they must be covered by an HDHP on the first day of the month. They must not be covered by other health insurance. They must not be enrolled in Medicare, and they must not be eligible to be claimed as a dependent. Now let's talk about contributions to an HSA account. Many people can contribute. The taxpayer, their employer, their family members, and others may contribute to an account. And all contributions, except for those made by an employer, may be used as an adjustment to taxable income. Now, employer contributions are reported on Form W-2, Box 12, using Code W. Employer contributions, like I mentioned earlier, are excluded from the employee's income. Now, there are limits on the amount that can be contributed to an HSA account. The amount that can be contributed depends on the type of HDHP coverage, whether it be self-only or family, the taxpayer's age, the date the taxpayer became eligible, and the date the taxpayer ceases to be eligible. Taxpayers who are 55 or older can increase their contribution limit by $1,000 a year. Total contributions made by the taxpayer, employer, family member, and others cannot exceed the contribution limit. For example, if the contribution limit is $3,350 and the employer contributes $1,000, then contributions made by everyone else may not exceed $2,350. Married taxpayers cannot share HSA accounts. Each spouse must have a separate account. And so contribution limits are split equally or can be divided by spouses by an agreement. If the taxpayer is eligible on the first day of every month with the same coverage for the entire year, then the full contribution is allowed. But if the taxpayer was not an eligible individual for the entire year, or changed his or her coverage during the year, then the contribution limit will follow modified rules. Now, one of the modified rules is the last month rule. And this rule says that the taxpayer can make the full contribution if they are eligible on the first day of the last month of the tax year, and if they remain eligible individuals during the testing period. And that testing period is defined as December 1st of the tax year through December 31st of the next tax year. Let's look at an example of the last month rule. If Chris became an eligible individual on December 1st, 2017, and he had family HDHP coverage on that date, and he also expects to remain eligible through December 31st of 2018, then under the last month rule, he can contribute up to the max family contribution limit for tax year 2017. Another modified rule is the sum of the monthly contribution limit rule, which says that taxpayers can contribute 1/12 of the annual contribution limit for each month eligible. And in order to calculate this accurately, we can use the limitation chart and worksheet in the Form 8889 instructions. Now, rollovers to an HSA account are not subject to the annual contribution limit. And they're also not deductible contributions, meaning they cannot be used towards an adjustment to taxable income. Rollovers are out of scope for VITA if the transfer is from an Archer MSA to an HSA account, because remember, anything involving Archer MSAs will be out of scope. Now let's talk about distributions from an HSA account. Distributions for unreimbursed qualified medical expenses are tax-free, which is one of the benefits of having an HSA account. Qualified medical expenses are defined the same way that medical and dental expenses are defined for itemization purposes. Now, there are a few differences and exceptions, and those include insurance premiums and drugs, which follow different rules. So if you encounter that when dealing with an HSA, remember to contact someone on leadership. Distributions used towards expenses other than unreimbursed qualified medical expenses are taxed as other income, and they're also subject to an additional 20% tax. Now, there are exceptions to the 20% tax, and that is if the taxpayer has died, has become disabled, or is 65 or older. And those are just exceptions to the 20% tax. So distributions will still be taxed as other income, but will not be subject to that additional tax. Now let's talk about the different kind of forms involved with HSAs. The first is Form 5498SA. This form shows the total amount contributed to an account, including contributions made by the employer. So remember, to calculate an adjustment to taxable income, we want to subtract out contributions made by the employer. So in order to find out the contributions made by anyone but the employer, we'll take the amount from Form 5498SA and we'll subtract whatever amount is on the W-2, Box 12, Code W. Now let's talk about Form 1099-SA, which reports distributions from an account. Code 1 and Box 3 will indicate a normal distribution. So let's look at how the HSA will affect the 1040. Any distribution that was used towards something other than qualified medical expenses will appear on line 21, Other Income, so it will be taxed. Now, any amount contributed by anyone other than the taxpayer's employer can be used towards an adjustment on line 25, and this adjustment will reduce taxable income. Now, there will be a 20% tax on distributions used towards something other than medical expenses, with a few exceptions that I mentioned earlier. Now that you've completed this lesson, you are able to recognize tax-favored arrangements, determine eligibility to contribute, calculate the limits on contributions, determine what qualifies for an adjustment, understand how to report distributions, explain the effects of distributions not used for qualified medical expenses, and identify information documents used in reporting.